Hey guys, I want to take a look at the spreadsheet that Early Retirement Now blog has been publishing for many years. So PhD Karsten Jeske, he's put out this spreadsheet and you should see there's dozens of blog posts and it's a really great resource for DIY investors. So I wanted to take a look at the spreadsheet with you all today, kind of give my thoughts and work through the spreadsheet and see how it is a great tool. It is kind of a lot, so if you haven't seen it before, I'll try my best to describe what's going on with it. But there is a great resource available by Two Sides of Phi. They've looked at the spreadsheet before and broken it down on their channel, and Carson's also been on many blogs, many podcasts to explain what he does. So I think it's a great thing to check out and a great resource for DIY investors. So let's open it up. First thing you'll do is just open this Google Sheet on his blog and make sure you save a copy of it, because if you don't, then you'll mess up the spreadsheet for everyone else who wants to download it. So this is my own copy. I'll close that old one. Let's make this full screen as well. Some links up top here, just further instruction. If you need some help orienting yourself in the spreadsheet, be sure to check those out. So one thing, Karsten does have a note here of the difference between safe withdrawal rate and safe consumption rate. These have to do with added income or expenses in retirement if you have pensions, Social Security, or assets coming in from different asset sales. Let's say you're going to sell a rental property and that's going to supplement your income in retirement, or you're going to buy something, a big expense like an RV or a vacation home or a boat or something. That's going to cause there to be a difference between the safe withdrawal rate and the safe consumption rate. So that's what this first paragraph is explaining. So for today, I just want to look at, let's not worry about any other supplemental retirement income, but just looking at, let's say I've got a $2 million portfolio, what's going to be the rate at which I can withdraw from that portfolio based on the data that Carson's put together here. So first thing, let's set up our portfolio. The default is 75% in S&P 500 equity fund and then 25 in a 10-year bond fund in the US. So I'm not going to change that, but if you did have either shorter or longer bonds, you could input those variables. Same thing if you have an emergency fund like a CD, checking savings account, you can input that in the cash amount here in the orange tabs. You do have FAMA French factor weights and FAMA French assumption weights. So that's probably a topic for a separate video, but basically the idea there is you can get added returns to your portfolio by overweighting small or value type of stocks relative to the broader market. I'm not going to worry about that today though. Expense ratio is 0.05 or 5 basis points. That would be in line with the index style portfolio that we have here of 75-25 on our $2 million portfolio. That'd be 1.5 in S&P and then $500,000 in 10-year bonds. So let's just keep working through this sheet. You can see based on this data over here on the left, it'll produce this table of results here. One thing I want to do is I just want to turn these grid lines off to make it a little bit easier to read for me. So failure rates of different initial consumption rates. Usually how these spreadsheets works is if you take an initial rate that you're going to spend from your portfolio, let's say 4%, that seems to be most common on a $2 million portfolio. That means I'm going to withdraw 4%, $80,000 per year, and then increase it by inflation each subsequent year. So you can see it's got different columns in as well. All of the returns data, returns since 1926, when the CAPE is below 20, when CAPE is above 20, and when CAPE is above 20, and S&P is at an all-time high. So you can see if your initial consumption rate is 3.25%, there has not been a period in this data set that has actually resulted in a failure, meaning you've run out of money before the end of your retirement. That makes me think I should also adjust the retirement horizon months here at 600 months. That's 50 years, which is good for early retirees, but I think a lot of people are probably more in that 30-year camp, so that would be more like 360 months. So we'll just update that. And then you can keep going down. So that next one, that 4%, is actually, you do start to see some situations where you could be in danger of running out of money. All the data, 1.44% of the time, you're going to actually exhaust your portfolio before the end of that 30-year retirement. And then it goes up from there. So culminating in about, 12% of the time when CAPE is above 20 and the S&P is at an all-time high, 11.9% of the returns of the retirement possibilities resulted in the portfolio actually being exhausted before retirement was over. I did want to take a look at 5% too. This is pretty interesting. You start at a 5% withdrawal ratio. It significantly impacts here about half the time. You're going to run into issues, especially when the CAPE is over 20 and the S&P is at an all-time high. About 50% of the time, you are going to exhaust the portfolio. If you go down just that table below, you can correspond your initial consumption rate to a target failure rate. So the idea here is if you want a 0% failure rate of all recorded history on this sheet, at least, what should you be targeting initially? So just under 4. It's pretty consistent across the board here, versus if I do want to live on the edge and I'm okay with taking more risk, what should I target? And that would be, call it a 5 to 7% initial consumption rate. So it does help frame up that decision of how much risk am I really taking. I think another way to say it is, different risks you can think about. If you have a 0% failure risk, the risk is at the end of your retirement, you have this big pile of money that you didn't get to enjoy. And maybe your goal is, I just want to leave a big pile of money to my family or my favorite organizations. Warren Buffett would certainly fall into that camp. He's not spending anywhere near 1% of his assets every year. So that would be the risk. Whereas on the other end of the spectrum, the risk here is if you do need to begin earning an income again to support your lifestyle, or you have to cut your lifestyle significantly in order to avoid completely draining your portfolio. The second column over here, failure rates conditional on S&P 500 drawdowns. So when the S&P is at an all-time high, this is pretty interesting. This takes a look at, depending on when you're retiring, where's the S&P relative to its all-time high. If it is at a high, you can see pretty consistently you're going to have a higher failure rate, meaning it's going to push you into a lower initial consumption rate than you otherwise would be. The ideal based on these numbers is if you retire in a down market. So if it's a greater than 30% drawdown, you can spend up to 5% per year, and there isn't a case where you've actually run out of money. So that's pretty interesting. Below that, safe consumption rate to target failure rates conditional on S&P 500 drawdowns. Just the same thing we saw earlier. Again, the most beneficial according to this chart is retiring in a bear market or a severe bear market where you're down over 30%. This would be like a COVID. You retired on during the COVID-19 pandemic, and the S&P was down just over 30% in about a month or so. These percentages are much, much higher than if you go to the left of the table and see what can you take out when the market's at all-time highs. Now, of course, it's a double-edged sword, right? Because if the market is at all-time highs, your portfolio is larger such that these percentages are going to translate to more dollars that you can spend versus these. So it's not like you want to wait until a bear market, because probably not going to be that big of a difference. And then on the far right, failure rates conditional on S&P 500 drawdowns. This further expands the percent drawdown, so 0 to 5, 5 to 10, all the way 40 plus. It's really interesting when you get on that edge case. You can really spend a lot more than you can at an all-time high. Again, though, your portfolio is going to be a lot smaller than it otherwise would have been. Another thing I really like on this page is the fail-safe around prominent market events, just to give yourself sense of self of, hey, what happens if a really bad situation comes up? You can see even the tech crash and the great financial crisis, just due to the strong markets post those events, you were safe to spend over 4% as an initial consumption rate, whereas the really, really challenging time, 60s and 70s, more inflation and lower growth, it was under that 4% in that 1964 period. Even after the Great Depression, it's pretty incredible. That was a horrendous event. Although when you look at the Great Depression, it actually helped that there was deflation, although that was a way different time period than today. So that's the first page, guys. We'll probably do a series on this. This is getting a bit long already, but just to highlight the first page, I'm barely scratching the surface with this spreadsheet. It's really great work, and there is even a web-based version now that Karsten has on his website. So check that out if you don't have Google Sheets or Excel. But looking forward to checking that out, and we'll see you guys later. Bye.